in South Africa are any different in asset management from anywhere else in the world. The problems we read about, hear about in the world, it's all relevant. It's all the same game. It's all the same stuff. So I don't think this is something that is a company or a country specific issue. So with that, let's jump into it. Look, we're all ethical people. Everybody on this call is a self-selected group of people who are interested in ethics, who think about ethics, and therefore who are ethical. And yet every one of us, including me, can make errors of judgment. It happens literally all the time. And I can tell you, if you're running a firm or in leadership of a firm or leading a team, if you are not paying attention, you will miss the fact that there is an ethical challenge at least every week and often every day. We look after people's money. Inevitably, it isn't just ethics of markets and capital markets and decisions, it's other people's money. And that brings whole layers of fair treatment, of fiduciary obligations, of duty of loyalty and care. And I think if it's important, if you have only one message today, I'm trying to give you a lot of information really quickly so that your antennas go up and you think about ethics as a filter of things that happen in your day-to-day life, from sales to fund strategies and across the board in this business. And ethics is gray. Ethics is not usually black and white, whereas fraud, illegality, breach of regulation is black and white. It's fraud, it's illegality. That's not what we're talking about today. We're not talking about those things. We're talking about ethical challenges, things that can truly represent the horns of a dilemma. And I'll try and give you a couple of examples. As I say, inevitably, when you're dealing with high-functioning individuals, particularly CFA candidates and charter holders or students, errors of judgment do happen and happen all the time, but it's errors of judgment. It's not intentional. It's like, oh my gosh, I just wasn't thinking. And for that reason, I think it's important to have what I would call a light touch, a learning touch, a teachable experience methodology that when things happen, you share it widely with your teams and you talk through the ethical challenges. You can lecture ethics, it doesn't work. Codes of conduct, we've all seen companies that have collapsed in enormous frauds with fantastic codes of conduct in writing, which nobody reads and nobody practices. It's sharing it as things arise. What I will say is this: while a lot of it seems quite gray, after you've done it for the 100th time, it's muscle memory. There are yes/no answers. It's like some people play card games or gambling games like blackjack. It becomes rote. The standard plays you make in standard circumstances, it's muscle memory, and it is true of ethics as well. Yes, you can do that. No, you cannot. And as a leader, you will develop that, and particularly if you're paying attention to all the cases as they arise. It's not as random as it seems. So let's just start with the first principle. And ethics in asset management is a distinct thing, as I've said, because we are fiduciaries for other people's money. And I want you to think, I'm going to just pause for a second. I'm not going to put a question on the screen yet. We're going to have some questions as we go through, which I'll look for quick, snappy replies to. But think in your mind, what is a fiduciary? It's a big word. It shows up all over the place. You're a fiduciary, responsible. It kind of has the weight of the, big, heavy books on your shoulders. But what does it really mean to you? Just think about adjectives for a moment. And let me throw some of those out that you're probably thinking. You think of my clients come first. I act in my client's best interest. I only do what my clients allow me to do. They give me a mandate, I work within my mandate. That's my limitation. So that's one broad theme. The second broad theme is I must apply ability. Can't just make decisions with no documentation, without due process, without diligence, without care, without paying attention. And if you think about it, if we make this really simple, a fiduciary has a duty of loyalty to your clients and a duty of care for your clients. Simple. And once you take on that burden, that responsibility, it is a responsibility. It's almost a sacred duty. It's people's money. It's his savings. That adds a whole layer to just running an investment process. You're not going to breach capital market rules as a fiduciary because, first of all, it's other people's money. They get the profits. But second, your filters are at a higher professional standard than a bank deal maker, for example, or a third-party speculator. So here's our first question. Let's do it as a test case. It's an easy and quick one. Martin's going to run the poll, and we'll all be able to see in the chat how people have voted for these things. So, quick question: can a fiduciary, given what I've said, negotiate against your own client? I'll give you a few seconds to think about that and throw your answers. We can't see the answers, by the way. We don't know who don't know who's saying what, nor do we care. It's a thought process. Remember, the only way to teach ethics is by case study. Okay. I'm gonna call that give or take 50-50 since it's shifting 48-52. That's pretty good. It's 50-50, right? Okay. So the answer is it's a good answer to say no, and that is generally true. However, you do have to negotiate with your clients. You have to negotiate your portfolio management agreement, your contractual arrangement with your client. That is a negotiation. That's a hard negotiation. You have to negotiate your fees with your client, right? I mean, that isn't just, oh, well, pay me what you want. It's a negotiation. It's a hard negotiation often. It's a back and forth. And I would argue that you should negotiate your investment mandate, your investment freedoms. It's your skills that you apply, that you write into the mandate, and you can only work within the mandate. Those are the things that allow you to add alpha. Those are the mandate freedoms, not mandate restrictions, freedoms that allow you to grab alpha opportunities, investment opportunities as they arise. If it's not in writing, you cannot do it. We'll talk about that a bit more later on. So after that, once you've signed those agreements, that's it. Thereafter, you should never find yourself negotiating against your clients. It does happen on mandate changes or fee changes, but that's the same thing over and over again. So your instincts, by and large, were pretty good on that question. The way I think about the world is this: everybody, between the ultimate member whose money I look after, whether it's a mutual fund unit trust investor or a pensioner who lives in a pension fund or a retirement fund, or an insurer who has funds, shareholder funds to manage, everybody between the money and the market is a fiduciary, whether it's a trustee, their lawyer, their advisor, an investment consultant, an asset manager, or multi-manager who I report to. We're all in what I call the fiduciary chain. And then there's the rest of the world. And everybody who's not in the fiduciary chain, their job is to get the client's money, to overcharge for investments, to scam us, to lie to us, to mislead us. I'm sorry, these are harsh words, but that's the way the world works, and it's getting worse in case you haven't noticed. Even exchanges aren't fiduciaries. They're not looking after us. It's our job to protect our clients within listed exchange environments. Those rules are not always written to protect our clients. So the whole world, think of it this way: you got a bag of gold you're protecting. We in the fiduciary chain have a bag of gold. Everybody else is trying to get the bag of gold. And if you start with that simple formulation of the world, it helps you know who your friends are and who you fight with, who you negotiate with aggressively, and who your friends are. So that's just a guiding principle that we apply. That said, there's some people in the fiduciary chain who sometimes cross over, who are doing things that might be unethical. So let's have a question. Has your firm ever had to fire a client? In my lexicon, it's a pension fund client. Your lexicon, it could be any other client, for ethical reasons, because you had ethical concerns about the client's behavior or practices. I'm going to take a guess that there's going to be an overwhelming response of no on this question. So because it's very hard to fire your clients. It's kind of sacrilegious to the business development team. Are we settling again at 50-50? Okay, I'll call that 50-50. Again, I'm actually surprised. To fire clients, we have, and to our credit, we fired clients who ultimately we determined through their behaviors that something was seriously amiss, and we said, please go away now. It's not. You're asking us to breach the rules. You're sending us instructions. People were not authorized signatories. You're sending us new bank account details that were not in the original agreement, and doesn't seem to be fully properly authorized. So you want us to transfer money. You want us to pay third parties who are not related to the fund out of the fund. That's sort of alarm bell, which we have seen, and I guess some of you have seen, given that answer. It warns you that you're dealing with a potentially dangerous situation. Not all trustees are ethical or legal or honest, and it's an unfortunate truth where people like us who have studied in the CFA program know what ethics is and ethics in investments is, but many people who become trustees or in the governance structure of funds were not schooled in that. They don't know what the boundaries are. They will step over those lines. They will ask you for kickbacks. They will ask you for inducements. They'll say, well, my son's going to university, and can't you help him out with his university fees? For example, we've got that. And I think you have to listen closely to your instincts. I'm really pleased to say the clients that we have either eschewed, that is not taken on, or gotten rid of ultimately ended up in court actions, legal actions from the regulator, and they were put into liquidation. And that makes me quite proud, actually. That means that our antenna are always twitching for potential breaches. Guys, I know you'd love to talk about each of these cases. I know you. We don't have the time. Let's go and go on to question number 3. So in our lexicon, investment consultants stand between us generally and the pension funds. They determine who the managers are, they determine what the asset allocation is, and they will appoint with the client us. So an investment consultant has asked us to contribute some money because the trustees are going to be having their annual trustee powwow meeting, breakaway at a hotel, a conference, and they've asked us to contribute to cover the costs of that. And the question is, should we? Is it suitable for us to pay for the fund's governance structures, their trustees? Good. All right. No is a good instinct. No is a very good instinct. I mean, we get paid, all of us get paid to provide an asset management service for a negotiated fee. We don't get paid to pay for the fund's governance structure, to pay for the trustees. The fund must have its own expenses. And these things get much worse than that. These things will be like, well, it's a big party and all the trustees will be there. There's going to be dinners and, it's at a nice hotel and they want us to contribute. And that's a hard no. And I mean a hard as in a firm no, which doesn't make it an easy no because it's your client. It's your client saying, well, we've got a relationship. You should help us. It's hard to do, but you can stand on the principle, and hopefully the people in the governance structure of the fund will appreciate that. They don't, in all honesty, don't. The only exception in our mind to that is if it's educational content. We consider that if they say to us, will you please pay for a training session for the trustees about investments, or will you fly in to do a seminar on your asset class or something, that's fine. Education and reasonably costed education content, we do want to support trustees. An educated trustee is our friend, and that would be in our mind both legal and proper. The other stuff may not be legal or proper. When it is an event, we will always ask, what's the total cost? How much are we being asked to contribute? How much are other people being asked to contribute? What's the money actually going for? Is it for the party or is it for the educational content? That's the key thing. Is it educational? Let's go on to the next question. And this is a hot button question across the industry, across the globe. So I'm really interested to hear how people respond to this. Should personal account trading by asset managers be allowed? In case you don't use that terminology in Slovakia, personal account trading would be you personally being able to buy and sell the assets in which you are investing for your client funds. If you're in a listed share market, are you allowed to buy and sell listed shares yourself, for example, or derivatives on those, or whatever is related to that? Should it be allowed? So I'm going to assume, based on the responses, I speak too soon. I'm going to assume, based on the responses, there's only 12-ish% that is saying no. In my experience, if you poll a large audience, which has a whole bunch of fund trustees, asset consultants, regulators, and lawyers, the answer is a hard no. They don't want asset managers, staff, trading personal account. They want all of that skill applied to funds. If you ask asset managers, we know that the actual rules of the game is, well, diversity is for clients. We want to use our skills and our tools and our resources to also make some money for our own account within our own risk tolerant portfolio. And there is usually, if you poll a large audience, it divides right along those lines, in my experience. So the short answer, or the correct answer here, is probably more of a maybe. Because the how matters. It goes to, sure, trade PA, but what are the rules in which you do that? But the first and best answer is usually staff should invest in funds alongside clients. You put that way, you're putting your best mind into the portfolio you're managing for your clients' benefit and equally for your own benefit. In fact, some of our incentive schemes within our broader group, our deferred compensation goes into funds we manage, so we are aligned with our clients, and we as a manager encourage our staff to invest in our own funds. That's the best way to do personal account investing, but that's usually not That's what I'm looking for. Risky enough for most people. They don't want to buy a portfolio or a balanced fund. They want to buy shares that they know something about or have a view on. And then you got to have a whole set of rules. And I'm not going to go through all these. I'm going to let you read the slides. But normally it's a thing like, well, you obviously got to get an approval form, and that's only good for 2 days. If you haven't traded, you can't trade it. Any trades you execute must go through a broker that gives reporting directly to your compliance department, so they always know what you're doing. Any client trades come first. If you want to buy a share, if there's orders loaded for client portfolios or about to be loaded, those always trade first, and et cetera. And there's obviously a limitation of how big the position is for in your personal portfolio. We don't want to see people trading highly geared futures positions that they're watching by the second. We don't want to see intraday trading. So there's a whole set of rules that we would apply to this to make sure the clients come first, and where people are trading personal is always trading behind the clients and within a suitability of size and risk taking. So, but it is a hot button. This. Question number 5. I am more ethical than the average person in the investment industry. Yes or no? Not I, Andrew, I, you. But you answer for you. Are you more ethical than the average person in the investment industry? You've all studied behavioral finance. You know that. You know this is a trick question. You all know if you ask 1,000 people, are you a better driver than the average driver? Oh yes, of course I'm great. 99% of people are better drivers than the average. It's the most remarkable thing. Anyway, unfortunately, and legitimately, we are in an ego-driven business. We all believe we are more ethical than the average, and that's not unsuitable. It's only dangerous because in believing we're ethical, that's when we start making errors of judgment. Those errors of judgment is never intentional. Honestly, somebody says you're about to commit an ethical breach, you say, "Whoa, I won't do it." It's usually when you don't realize, oh, geez, I traded that share and I forgot about the PA trading rules. Oh my gosh, I traded the PA share. I went through the process, but there was a client trade that hadn't been executed. You didn't know, but it does happen all the time. And the problem with that, of course, is it activates your rationalizations. It activates your ability to trick your mind into saying, well, it's okay. It's okay if I do it. I worked all weekend. Yeah, admittedly, I took Monday off and I didn't put a leave form in. But I worked on Saturday and Sunday, so I'm entitled to it. Right? No, you're not. That's a short answer as an employer. You are not. We bonus you. You are expected to work overtime. You take Monday off. You put a leave day in for it. But that's the kind of decision that get made all the time. Even little things like expense claims. But obviously, within the investment world, there's a whole range of these rationalizations. And most of these rationalizations will apply to some of the biggest frauds that have emerged as well. People who are good CEOs or CFOs of companies who really were ethical people, but as things went from bad to worse, well, I've got to protect my team and with my family, and the bonus pool for the group's going to go down this year if I don't do this and tweak the books. Ethical people led the wrong way by these rationalizations. Hey, look, it's legal, it must be okay. Hey, no one was hurt by this. It was just a little equity trade. Nobody got hurt by this. It was a victimless crime. Everybody does this. So if I don't do it, the other guy is going to do it. Right? You've all heard these things. This thing on the right-hand side, the metaphor of the ledger. I'm an ethical person. We all believe we're ethical people, right? So we can do stuff that other people can't do because we're ethical. You've got to tune to these things. This is where you get into trouble. This is where we go down the slippery slope. This is where we see the errors of judgment. Actually, more often the errors of judgment are just people just forget. They literally just can't operate in the filter of the hunger for investment returns, of seeking alpha, of the hunt and the kill, which is the testosterone-driven thing that makes many of us work, and throwing an additional boundary filter on that of the ethical considerations of that. So I think that's the key message. Pay attention there, and the ethical stuff is there all the time. Question 6. Put that up, Martin. The portfolio manager, you might have to think about this one. The portfolio manager of a low-risk money market fund has just purchased a 1-year bank deposit, NCD, but it has an embedded equity market call option. So essentially it's getting a lower yield for the year because it's got a call option embedded in it. Is that a suitable investment strategy? Is that okay? You guys are just saying what I want to hear now. People do this all the time. This is, I mean, you think it's an obvious answer. This literally happens in our market with regularity. We see it. We see our competitors doing it. Seems like a good idea. It's a call option. I can't lose money. All I can do is write off the call option. It's a money market fund. Why shouldn't I get some equity upside in my money market fund? Pretty self-evident. It's a great investment. It's a great way to get superior returns over my competitors without any downside. It's a call option. You guys aren't going to change your mind. 91% of you say no, and the answer is it's not. If it's not in the risk mandate, you cannot do it. You can pretend. Unless the money market fund says you're allowed to take some equity market risk, you cannot do this. We are fiduciaries. We work to mandate. In fact, if that call option makes money, the client might fire you anyway. If the call option loses money, the client should claim from you the difference between the yield they would have earned on the money market asset versus the yield they actually did earn, because you had to give up some of the yield to buy that, embedded by that call option. So it's got to be in your risk dashboards as next to exposure. It's got to be in your mandates as allowable for equities. But I can tell you, again, you think it's self-evident. Within the context of an ethics presentation, the answer is no, but I can tell you this happens all the time. People put all sorts of weird. An alternative is structured credit linked notes. You buy a bank deposit with additional credit risk layered inside it, which is hidden from the clients. It's got a credit default swap hidden on top of a bank deposit. Clients can't see it. Doesn't show up on risk dashboards. Maybe breaching credit limits in the portfolio because you're gearing a fund on credit. People do it all the time. And I genuinely believe it's an error of judgment. They're just not applying their minds to thinking about how their mandates work. So this is real stuff. These examples I'm giving you are real examples. I hope you've figured that out by now. Okay, I've covered this. Okay, it's Christmas. It's December 16th. The beautiful black box Mont Blanc has just shown up on your desk. You open it, and it's a beautiful Mont Blanc pen. What do you do? It's a friend of yours from Global Bank Inc. So in South Africa, send it back. In South Africa, we have our regulator a few years ago, well, several years ago now, said asset managers cannot accept gifts exceeding 1,000 Rand, call that 75 US dollars, per person, that's Andrew, per person, per counterparty, that's Global Bank PTY, per year. So theoretically, I could accept a $50 gift from that person and 50 from this and 50 from that, but per year. So if they take me out for lunch, they spend $40 on me, no more gifts from that person per year. It's actually a good rule. It not only puts a hard limit on things like, well, let's go away for the weekend, let's go for the overnight train trip, let's go out and pop some expensive champagne, let's take a Mont Blanc pen. It not only knocks that out, but it forces compliance systems and asset managers to actually create a reporting mechanism for this. It forces you to build systems so you can keep track of this for every year. And you learn a lot of ways how banks try to get around it and how we have to make sure that we don't accept those gifts. So within that limit, we can accept gifts as long as we disclose it. A Mont Blanc pen would be above that limit, so you would normally send it back and say you can't receive such gifts. There could be an argument that it's on the margin. You could disclose it, keep it to compliance and keep it, disclose your team, or give it away. I see nobody's chosen that option, and that's correct. Giving it away doesn't clean you unless the counterparty knows you've given it away. The way I try to teach the team is this. This thing was never intended for you. Global Bank PTY doesn't like you. They certainly don't like me. I'm their adversary. I've already defined for you that they're on the outside of the fiduciary chain. They're my enemy. And so I know they don't like Andrew. And you should know they don't like you. They like your seat. They like your client's money. They're trying to bribe you. That's what they're trying to do. Once you jump over that wall and realize that somebody is literally trying to bribe you, your antennas then twitch. Things like, wow, I don't know, I'm not bribable. That's not me. I'm in the asset management business. I'm a fiduciary. So it's a good boundary to have. It gets a bit tricky. A couple of years ago, I got a birthday cake from a bank. So what do you do with a birthday cake? You can't send it back, right? I'm not going to spend the money to send it back. It's a birthday cake. So you cut it up into a lot of slices, you share it across the whole firm, and we said thank you. So you have to be pragmatic about this as well. Otherwise, any gifts that come in during the course of the year, any gifts that come in, if they're too big, we send them back. Anything small goes into a charity box. And at the end of the year, we have a charity auction. The whole firm can bid, so it doesn't go to me or anybody else. And bid for the gifts, and any money raised goes to a charitable contribution. Otherwise, it's like, what am I going to do? Take a 100-round bottle of wine and spend 200 rand to ship it back to a counterparty. It's just, you have to be pragmatic while being ethical. Okay. Gifting has been a serious problem in Ireland. I don't know how it is in Europe. South Africa has more or less solved it. It is known. It's a known issue. Asset managers are very well versed in this, and every firm has dealt with this. So it's really not as big an issue as it would have been, say, 10 years ago. So my headline of the presentation is, if you're paying attention, there's an ethical dilemma almost every day. Now, what I'm going to do is I'm going to throw up a whole laundry list, which we don't have time to talk about, but it'll give you an idea of some of the things. And again, these slides are available to you. It's already been PDF. Martin's got it. It's available immediately. You don't have to take any notes on any of this. So please don't scribble. You don't have to, or screenshot. It's all there. But some of the things that we see, the gifting, I just talked about that, gifting, getting requests. Trustees will ask for gifts. That happens. Client event sponsorships, I give you a case study now. We get that at least 3 or 4 times a year where clients say, well, the trustees, we've dealt with that. Market manipulation, I think that's probably more in the realm of illegal than unethical, but I'm going to trade a few shares and push the share price up so I get my month-end values a bit better. That's old school. That's been going on for 150 years or more, about how to manipulate markets to make your portfolio look better or clean it up. Hiding risks in structured products, we discussed that through that case study. Happens all the time. Asset managers are too enthusiastic for alpha, and they forget they have a mandate to work to, so they buy structured products from a bank that hides all sorts of risk the client never wanted, never mandated, never asked for, all to get an extra 3 basis points or whatever return. It's really just professionally stupid and risky. Then there's some more subtle things like, you send out your business development person, your salesperson, you call them a portfolio manager, right? They're not a portfolio manager. They shouldn't be misrepresented. We see this all the time as well, misrepresenting who you're putting in front of your clients or trustees. Asset valuations of off-market assets, very tricky area, very tricky, ripe for games playing, particularly if you're on incentive fees. We could have a whole 2-hour seminar on that, which we don't have time for, but you can imagine that that's a problem. MMPI and inside information, inside trading, when you have it, when you don't have it, how you make sure it doesn't get used or passed on. Client privacy and confidentiality, and these days staff privacy and confidentiality are big ethical issues in our business. You have to contract people, your staff coming in and going out, about how they protect confidentiality, your systems, your processes, your firewalls. Client privacy is an ethical issue, actually. Performance presentation, if your chip's compliant, well, that's great. If you're not, we all know how asset managers can misrepresent their performance. Relevant benchmarks. You set a high risk. You have a high risk equity universe, but you set a broad market index as your benchmark. Well, that's edgy. That's edgy. It's not relevant. It's not the same risk characteristics. That you're not comparing like with like. So setting benchmarks is an area for potential ethical abuse or misrepresentation to clients. Trade allocations is something I have always been astounded that clients don't ask about. We run, I don't know, they make a 50 chips composites, probably 300 or 400 portfolios. By the way, Martin said we have $1.3 billion. He lost $10 billion there. It was $11.3 billion. So we run a lot of funds across a lot of chips composites, and they all share elements of interest rate risk and credit risk and market risk. And clients don't say, well, how do you allocate trades? They should look very closely at that, because some clients think, I'm going to pay you a higher fee, so I'll get more trades. You can't do that. You work to mandate. You have to have fair allocation rules. This is a big black hole question that nobody really focuses on, is how transactions, good transactions or bad transactions, are allocated. Some people put the crappy transaction in one fund and the good transaction in the other fund, because that's his shop window fund. Old school stuff, but still goes on. True to label, does the label of a fund actually represent what's in the fund? That's an ethical question. The age-old problem of asset managers. I want to grow my business. I'm driven by growth of my AUM, growth of my profits, growth of my bonus pool. But we all know, if we're being honest with each other, there comes a point where you get too big just to add alpha. And I wish all of you get there, by the way. I hope you all get so rich by growing your firms with good performance that you reach the point where you can't grow alpha anymore. But because that's our holy grail, is that break point. Reach that point and go no further, because after that you start degrading client returns. But this is a true ethical challenge. Where do you cap assets to protect the clients you've got, the promise you've made? PA trading we've talked about. If you have fairness in your fees, your fee disclosures, double dipping of fees. I don't know if you're aware of double dipping. I want to pause on it because it happens again all the time. You've got a portfolio. It invests in other sub portfolios you manage. This is quite common in today's world. For complexity, you have to pool client funds in many cases, but you charge fees here and here. Many people do. That's called double dipping. I'm charging you 50 basis points to manage your portfolio here, but oh, by the way, I'm charging another 50 basis points within this sub fund. That's double dipping. You're charging client over 100 basis points. It's either going to be disclosed and approved by the client explicitly, or you just don't do it. I'm highlighting it as a big ethical dilemma because I know it happens all the time. It's like one of those things. It's almost like I can get away with it, so I do it. Transaction fees. Sometimes you'll get underwriting fees. You get access to IPOs in the old days, and who do those get allocated to? And whether there's some upfront gains or upfront commitment fees using client funds. Who gets those commitment fees or underwriting fees? We put them to the client funds. It's their money I'm using to underwrite. Many people do not. They say, well, I've done the work. I did the analysis. I made the investment decision. Why shouldn't I get that extra money as part of my fee base? You can have a debate about it, but disclosure solves that ill if you want to go that route. Regulatory reform. Regulators put out questions for comment all the time, and people always comment. Are you commenting because you genuinely believe it's good for the market, or you genuinely believe it's good for you? And I think that's an ethical question nobody really talks about. Product development. We're going to have a case on that just now. To make a product because the market wants it, or because you can do it. How you deal with joiners and leavers, your team, your staff. When people join you, do you immediately sit them down in a dark room and beat them up about their previous employer's investment process, their previous employer's clients, their previous employer's investment philosophies? Do you? I think some people do, but that's an ethical question. Mis-selling of client suitability, liquidity. That's the true label question. And access to competitors' information. Something comes across your desk that's inside information about your competitors. What do you do with that? Fair game, they're to your competitors, or not fair game because you shouldn't have it because it's inside information about them. Guys, we can't go into all these. The point is, and this is not a comprehensive list, the point is, if you're paying attention in our business, there is an ethical dilemma all the time. Again, I'll repeat that. Okay, let's look at this one quickly. Question number 8. Your new employee brings a spreadsheet model that she built at her previous firm. Is that okay? And what do you do with it? Okay. So our employment contract says you come with what's in your head and you leave with what's in your head. That's what I expect of investment professionals, is you don't take anything with you, but please don't bring anything with you when you come here, and we will not ask you. So the choice here, and I think we all know, is between B, delete it, just say no, and whether you actually discipline that person. I'm gonna lean away from discipline. It's fair to assess that it's likely the person just made an error of judgment. They didn't know the rules. This is a entry point teachable moment. That's not how we do things here. This isn't the house you joined. And in that, you've taught that person an important lesson about the ability to have a dialogue about these situations, as well as what you will accept and not accept inside your firm. So you all know we can't use it. That you got. Let's not go into a disciplinary process and punish. Let's teach. Let's teach others at the same time if we can. And ethical culture, as I said earlier, is a lived culture. It's how you make decisions today and every day. It is not what's in your policies. Nobody reads your policies. Nobody reads your emails. Nobody will review the code of conduct. Nobody will read your PA trade rules again after they join the firm. It's how you live every day and the decisions you make every day as a leader or a colleague in your business. Question number 9. A large client is insistent they want a frontier equity fund. I put African, in my context, but a frontier equity fund. And it's a big client. They've demanded that you make this fund for them. They think you can do it. We don't have the confidence in the process. And by the way, we think the asset class is probably overvalued. Should we create this product? I think there's 2 levels to this, and you've got the 2 levels. And there should be a fourth option, which is A and C. Because the truth is, forget about this fund. You shouldn't sell clients something you don't believe in. If an asset class is overvalued, just because the clients want it, don't feed the quacking ducks. Don't give them what's bad for them. That's not going to build you a long-term client relationship. That's C. And A is, if you can't do it, don't do it. If you don't have the team, the process, the track record, and investment thesis, a reasonable and sustainable investment thesis, and an analytical method, just don't do it. It doesn't matter what the clients say. And more importantly, it doesn't matter what your business development and product development team says. But Andrew, but the clients want African frontier debt. You must do it. You're the credit people. You can do African frontier debt. I'm like, I wouldn't put my own money in African frontier debt. If I'm going to go to Africa, I'm playing in the private equity space or the equity space, not debt, right? So that's the filter you apply. Don't do it if it's not good for the client. Don't do it if you don't have the competency to do it. I think you all get that. Your answer shows very clearly you understand the 2 sides of that. Okay. The best filter, if there's an ethical challenge every day, the best filter you can apply to yourself and within your team, but to yourself in particular, if there ever comes a moment, any moment ever, where you think, oh, I'd rather they didn't know, either my boss or my colleague or my clients or the press, anybody, if you ever have that moment, you know you're in the danger zone and you must shut it down. Because that moment tells you everything you need to know. It tells you there's an ethical dilemma. Your inner heart, notwithstanding whatever the opportunity presented is, your mind is telling you, I hope they don't find out. And that is telling you it's an ethical problem, an ethical dilemma, and a no-go zone. So I give you a laundry list. Is it legal? Does it feel right? How will it look on the front page of the newspaper? Would you embarrass if they know? What would a reasonable person think? You know, and I'm relying on you because you're investment professionals anyway. You're trained in this, right? I'm not talking to a broad audience. So just listen to your inner voice, please. Let's jump, Martin. I think we're short on time. I'm going to jump over this one. So let's just skip this if you don't mind. I think this one's a really interesting case. So let's do this one. Slide 11. Sorry, Martin, if I screwed you up. Can you jump to question 11? I'll let the guys read it while Martin's trying to get back in order. Thank you. You made a loan. You have a loan that has a mortgage bond. That is, you have security of a building. So if they don't pay you back, you can take the building. They haven't met their obligations. The borrower is defaulting on the loan. They're not making their payments because they can't make their payments. They don't have enough cash flow. So you have 2 options. You can take possession of that building through normal legal process, quickly, easily, efficiently. They missed a payment. The contract's clear. You have the mortgage bond. Take the building, sell it, and you can get back 100 cents on the dollar of your client's money. And you can do it quickly and expeditiously. In fact, you can get 100 cents back after recovery costs, legal and operational costs, to get that money back. 100 cents on the end. But you'll put the business out of business because you sold the building. Option B is you restructure that debt. You give it a haircut because they can't afford the cash flows to pay you back. You actually reduce the cash flows they have to pay you by reducing the capital or the interest payments, but force you to revalue the debt today by 30% downward. So you mark it down from 100 cents on the dollar to 70 cents on the dollar today in your client funds. But you let the company go on. Okay, people, how do you want to vote on that? Good. 70 say take the money and run. 30 say let the company live. And there is no answer. It's this one. This is a real case. We face this. We are a lender. We are sometimes a sole lender. We do take security over receivables books, over movables, that is trucks and vehicles, sometimes car fleets, sometimes buildings. This is a real issue, and it's a real challenge. And unless your mandate is clear that you can actually take a loss in favor of protecting jobs, you have a problem. And we've sat at our own credit committee bouncing this one back and forth without clarity. But in the South African context, and I feel pretty confident about this, and I'm guessing in your context, if you're managing local money in the local markets with local employers, your clients, if asked, would say, don't put 2,000 people out of work. I would guess that they would rather, within the fund context, possibly give you permission to take that loss. But I don't have that in writing. So it's a tricky one, but this is real. And that's a real ethical dilemma. This one's a bona fide, there is no road answer on this one. 70-30, interesting answer. Okay, moving towards some closure. Then there's this whole movement about being a responsible investor, ESG, integrating ESG into your investment process. You know, there's a whole bunch of stuff about benchmark cognizance where you're forced to hold companies you don't really like on an ESG basis, but they're in your index. And so you kind of you can underweight them, but you're forced to have them or else you're way off benchmark. Dealing with issues of harmful products and practices. I mean, do you have any oil companies, coal-fired power plants in your portfolios at this point? What does your client mandate say? There's a whole bunch of ethical challenges here as a responsible investor. You know, governance is bad, but the company's profitable. What do? Gauge, vote with your feet, stick around for the ride. It's really tricky. I want to give you a real example. I don't know if you guys in Europe know the company Glencore, but Glencore is one of the largest global. It's the old Mark Riching company from Switzerland, but it's listed on the JSE and the London Stock Exchange. It's a South African company now, and they are one of the big global commodity trading giants, along with the likes of Trafigura. These guys, it's pretty well known how they operate in the world. In fact, you guys have a war zone next door to you in the Ukraine. You can be 100% certain that Glencore is one of the people helping Russia get around the world's embargoes on Russian commodities and oil in particular. You can almost with certainty, I can say that. So my question to you is, given what we know about that, do you have, or would you have, Glencore in your portfolios? So you're in Slovakia, so it's not in your benchmark, so it's easy for you. The South Africans are the 6% who voted yes, because the problem with Glencore is about 1.5 to 2% of the South African equity market. It's one of the top capitalization shares on the Johannesburg Stock Exchange and in the index. It's very hard to go to zero weight in a company that's that big in your index. It's a real conundrum, but let's not sugarcoat this. This country literally pled guilty to graft and market manipulation to the U.S. government in 2022 and paid $1 billion fine. This is the quote from the U.S. Attorney General at the time. The scope of this criminal bribery scheme is staggering. Glencore paid bribes to secure oil contracts. Glencore paid bribes to avoid government audits. Glencore bribed judges to make lawsuits disappear. Glencore paid bribes to make money, hundreds of millions of dollars. This is a matter of public record. This is a tried case, and it's absolutely true. It's absolutely true, but they're big in our index. And how does an asset manager claim to be ESG cognizant and run a responsible, sustainable investment process with ESG integrated when they hold this company? And oh, by the way, then there's a postscript. In September, they paid another $500 million fine for manipulating oil prices. And again, we will be sitting here in a year's time, and I promise you, I can't say this. I mean, that's probably libelous. There's a fairly high probability that they are right now, along with Trafigura and the gang, going around embargoes on Russian commodities. Almost certainly, that's what they do. That is the core of this business. So how do you, as a responsible investor, close your eyes to that? I really don't know the answer. Thankfully, I'm not an equity investor. I don't have to answer. What I will tell you is the real problem is benchmark cognizance. Until clients, trustees, equity investors are willing to tolerate asset managers going way off benchmark on a responsible investor view, these things are going to persist. It's just going to, you just can't survive being that far off benchmark, because let's face it, the companies that actually do bad things often make more money for longer periods of time. It's a real problem. But the point is, it shows you the kind of ethical dilemmas you'll have once you claim to be responsible in the world. Okay, and then my final question. This is a fun one. The ESG movement. I'm interested to know what your feeling about the global ESG movement is. Okay. Numbers changing. For the moment there, you thought it was an appropriate investment strategy. Okay. 52, it depends. Look, for me, it can be an appropriate investment strategy. Sadly, in the world today, the correct answers look like all of the above. It may be a political movement, as is being charged in the US, that it's well beyond investment thesis and well into being a woke political movement. It could be a marketing shtick, and I think we all know that's happening. It could also be an appropriate investment strategy. Good analysis of non-financial factors can really highlight companies that are at risk. We've seen it, we've done it, we've avoided, and I'm sure you have as well. You can spot the ones who have great financials but are fraudulent in advance if you're paying attention and running proper assessments of non-financial risks. So it can be an appropriate investment strategy, and indeed it might depend. So the way we think about that, just as my final thought, is notice I didn't use the phrase ESG. I use the phrase non-financial factors, and that could be everything from the regulatory framework to alignment of incentives with management. Obviously governance writ large, because governance is risk management and committees and how the committees function. It's the culture of the firm or the ethos of the firm you're dealing with. I mentioned Glencore as a company which I assess has a very, at its core, it's a corrupt culture designed to arbitrage markets. That's what it was designed to do. It shouldn't be a listed company. What their accounting standards are and their accounting practices, you can assess that rationally as an investor, and in so doing determine the conservatism and reliability of those accounts. That's a non-financial factor. There's a whole range of things you want to think about and apply. And of course, the thing that really sinks companies is one of these. You have to look at them all to figure out the one that's going to blow up the company. Whether it's a company that could cause a huge environmental disaster, that is the big smoking elephant in the room. Whether it's a governance risk, that could be the big thing that blows up the business. So I would urge you to stop using the moniker ESG and start thinking of yourself as a responsible investor, integrating a range of non-financial factors to assess risk and return, so you can price risk. Demand more yield, higher risk, higher return. Simple as that. If you can assess these factors, you can assess the risk. If you can assess the risk, you can assess the appropriate return. That's genuinely how we approach. We're a credit house, so it's fairly easy for us to think about variegated credit ratings, default rates, recovery rates, and tweak risks for these kinds of things and demand more basis points for it. Much harder in the equity world, of course, because you're forecasting cash flows. That's the way. Okay, last slide. Martin, we're going on for 55 minutes. Defense against the dark side. Remember what your purpose is. You are here to serve clients and allocate capital. Be aware that you face ethical issues every day. I talk about your inner Buddhist. Buddhist philosophy is, the attachment is the root of all suffering. If you can avoid the attachment to your ego, to your bonus, to the gifts that are clearing desk, that's going to go a long way. Disclose everything. When in doubt at all, disclose anything and everything to everybody. Just send an email. It's going to be your best protection. Openly discuss these things when they arise. Build that ethical culture. Learn from examples. And just check your self-interest. What is the present value of your career? What's the present value of your reputation? Okay, I'll stop there.
Thank you very much, Andrew, for a great presentation. Was very dynamic. But we have one question. from Sader Farhat. The question is, at what point do political views become personal instead of the Ukraine example? What about something more contentious, like investments into occupied territories in Israel and Palestine?
Yeah, it's a problem. No, guys, it's in judgment-based investment process. I think we are lying if we say we don't bring our own biases to the game. I think it's true, and as with any investment discussion about risks, returns, upside, downside, likely outcomes, those things should be brought to the table as true, and have a debate about it. Have a debate. This company does business with Russia. Well, how do we feel about that? What should we do about that? Is it our role? What you do end up taking political views. Inevitably, you do. It's a hard question, and all you could do is have an open discussion and document it, and make sure that you're acting in your client's interest. Sorry, there's no easy answer to that one.
Yeah. Okay. Okay. So now,
the easy answer is to acknowledge it. Don't pretend it's not there. Don't stand up in front of clients. Oh no, we're holier than thou. We never bring ourselves in. It's impossible not to. All of us who are victims of our news feeds. We'd be lying if we didn't acknowledge that.
okay. So now officially it's like Q&A. So if you have any question, please raise your hand, ask a question, or post it in a chat, and I will read it for you. One way or the other. We have another. Ukraine bonds are priced now at 20%. What do you think about buying them? I don't know. This is discussion. It's more ethical, more investment.
What's the first ethical rule? Is you admit what you don't know. Guys, I don't know. Honestly.
Okay.
You live next door. You decide.
Okay. Next question. Is there any? Or you can raise your hand and ask a question directly. If you have a camera, then you can turn on your camera and ask the question. Please feel free to ask. Now it's the time to ask.
Surely I must have said something provocative that annoyed somebody. That's my hallmark, guys. Surely you want to argue with me about one of those case studies.
Okay. If there is there was someone who raised his hand. Yeah. Pavel, please go ahead.
Oh, just hello, Andrew. Just one question, very recent question. Basically, what's your opinion on the fact that the representatives and management of Silicon Valley Bank, they sent their shares a few days before they went down. So,
well, I happen to miss that news story of all the things I've read, but it's of course diabolical. It's unacceptable. It's probably illegal, and hopefully they get prosecuted. We've just had a similar case in South Africa. Company's share price has dropped by 80% in the last couple of days. And it turns out the CEO sold a bunch of shares 3 months ago. So yeah, it's not. Yeah, that's the end of that business essentially. It's a real problem. So, and it's illegal. So, even if it's disclosed, it's probably illegal. That inside information.
Okay.
Yeah, and we all rely on some fairness in capital markets. That's why our regulations, I'm sure yours as well as ours, talk about you should buy listed instruments because they're regulated. They trade in a regulated environment with disclosures and suitable minority protections and suitable protections from trading against you in the equity market. That's for bonds, and so that sort of thing is just it just violates capital markets and increases the cost of capital for everybody ultimately.
Thank you.
Can we have another question? Alois, please. Go ahead.
Hi, Andrew. Thank you very much for your presentation. And my question would be, have you ever seen somewhere in the world, or do you believe in a self-regulation regarding to the ethical questions that could be done somehow by the investment industry itself?
Well, yeah, yes and no. I mean, first of all, if we start with, and I'm not here to tout just the CFA line, although I do believe in it. We start with making ethics a core part of education. We write and we edit and we revise a code of ethics and standards of practice, and which is only 2 pages, and which is actually pretty reasonable and can be tested and understood, and people can keep it on their desk. That's the starting point. And then the second part of that, and it is a self-regulatory thing. There's things that we could be doing that clients would never know, whether it's manipulating one fund versus another, or fair allocation, or shoving costs into funds that we should be bearing ourselves, or accepting fees for the house that should be going to clients. Clients will never know that, actually. So the asset management industry has evolved holding hands with regulators, where there are regulatory authorities in probably every country with a reasonably sized asset management industry, but there's also the requirement to have internal compliance officers. That is, and in South Africa, our compliance officer has a very clear delineated line of reporting to the regulator. So they have a dual reporting line. They work for us, but they report to the regulator in case of anything, and the regulator has a person who is deployed into the firm. So it's a form of self-restraint, self-regulation, self-education, knowing what's good for you, because we're in the trust business, right? We're fiduciaries, asset managers. You're in the trust business, so your reputation is everything, and your self-interest, coupled with a regulatory framework and structure that creates a reporting line. If you're tempted to do something beyond the bounds or beyond the edge, your own compliance officer becomes the policeman and the spy in the house. That's how we do it. And I don't think that's unusual in the world. I'm sure there's many jurisdictions that do that. So it's a combination. I don't think a quote unquote self-regulatory answer alone would do it. It's just too many. It's going to be always the small firms who go off the deep end, who have no restraint, there's only 3 people in the room, and there's one of them's a dominant CIO. It's not gonna work. The requirement to have a compliance officer is a really great firewall, if you will, or roadblock or speed bump to unethical behavior. Incentives also make a difference. I mean, you think about banks. You think about banks that systemically blow up every few years because some dimwit traded $1 gazillion of copper futures, or went long in the equity market and hid their losses while they ran up billions and billions of losses for a bank. Banks blow up all the time because traders get out of control. I don't think I've ever seen that or heard about that in an asset management firm, ever. Our dealers just aren't paid that way. They don't get a share of profits. It all goes to clients. So your cultural framework, your operational framework, and your bonusable framework is just so different that it acts as a mitigant to the baser instincts that you might get rogue traders in our business. Just as an observation.
Thanks.
Okay. Any other questions? If not, then I would wrap it up. Thank you very much, Andrew, again for your presentation. Thank you very much for accepting our invite. We are really, really happy that you accepted our invite and gave the presentation we haven't had before on the topic that we haven't had before. I thank you very much for that. I found you on the CFA speakers list, but before I saw you in one of the CFA Institute videos, and when I saw you on that list, that I told myself that I have to write you write you an email. So I did, and now it's the great presentation on very interesting topic. This is going to end up on YouTube eventually on our channel of CFA Society Slovakia. We will promote it on LinkedIn and Facebook. So
I could look forward to a letter from Glencore's lawyers accusing me of libel. It'll be a really interesting case. And they're found to be avoiding sanctions against Russia here. No, but anyway, great.
yeah.
Martin, I don't mind if you want to close off the official section. You and I can stick around for a few minutes because I often there's people with stuff in their mind they don't want to discuss openly. We can stop recording, and I'll stay on for a few minutes, even though you close off.
Okay. I'm stopping recording right